Very good evening, participants. It gives me great pleasure to host today's webinar, which is very interesting and contemporary in nature when plethora of IPOs are hitting the market in the digital side. Avendus Capital is going to present the very interesting topic today, coming transformation of India's public equity market. It is by Avendus Olivo. And we have two distinguished people I have with me to present this strategy to all of you. Mr. Ranu Vohra, who is head of Avendus, and he is the co-founder and executive vice chairman with 2 decades of experience working in India and abroad. And he is an MBA from MFS and a mechanical engineer from IIT New Delhi by education. Joining Mr. Vohra is Mr. Tridib, who has got 32 years of experience in equity market and is the co-head of equity. Before joining Avendus, he has worked for Enam Asset Management and who is responsible for investment process at Avendus. And he is a chartered accountant by education. And the flow of events will be like this. First, both the distinguished guests will present the strategy for you. After that, we will take a Q&A. And there are some questions which have come already to us from the participants. And you can also definitely post your questions, which will be answered. The stage is yours, Mr. Vohra and Mr. Tridib.
Thank you very much, Mr. Sivaram, for giving us an opportunity to speak with the distinguished audience here. And my warm welcome to everyone. I think what we're going to discuss today is a thought piece, which hopefully you will see play out in the next few years. It's about the transformation of India's public equity markets. As I heard Mr. Sivaram talk about our experience, 2 decades, 3 decades, I feel that this is something very new. So we are starting from scratch, everything. So our experience comes in handy to a certain extent, but is also a baggage to a certain extent. So we are now trying to kind of build this capability, this knowledge from scratch. But what I want to do is I want to share with you on who we are as an organization, and that will give you a context of what we are looking at this whole situation from. So what is Avendus? Avendus is essentially in 4 businesses. It's in financial services in a broad way, but the 4 businesses are investment banking, wealth, asset management, and credit. In investment banking, we are among the leading advisors in the country. We've done, kind of more than 150 M&A deals, about 220 private equity transactions, a lot of them being cross-border. And Tridib, if you can just go back to the earlier slide. Thank you. And then we have kind of, received several kind of confirmations from our kind of distinguished juries on being the best investment bank of the year multiple times. Avendus's kind of starting point has been, investment banking. We now have a full-fledged wealth management business, which is focused on business owners, entrepreneurs, and we are providing them a lot of advice today in terms of their investments in different asset categories, including the category on digital and tech, which we'll be talking a bit more about today. We have asset management as an area where we are now just in excess of $1 billion in assets. And we have 3 specialized strategies. We have a hedge fund, we have a debt plus and equity minus product there. Tridib himself is part of Ocean Dial. He is co-head of equities at Ocean Dial and a person who has, with his experience, now kind of leading us both on the onshore and offshore side in terms of investments. And then we have a PMS Olivo, which we think will be a game changer in the Indian context. And we have a private fund, which is, again, as you would expect, aligned to what we do or know the best, which is, private companies which are in different stages of growth, but largely in digital and tech, again. We have a credit solutions business, which is focused on medium enterprises and providing them solutions for their cap table, which are not equity, but debt-oriented, and different kind of solutions where we invest out of our balance sheet, and we also invest out of, kind of the debt which we've taken. We have KKR, one of the leading global private equity funds, as an investor in Avendus. They invested in our business effective 2016. Early 2016, they've been investors in the business and a valued investor. What it has enabled us to do, if I were to kind of put in some substance of all of that, is that over the last 21 years, Avendus has focused on being very close to entrepreneurs, private equity funds, participants in the market. That has given us insight into several industries, whether it is digital and tech, consumer, industrials, and going deeper into those industries has given us a vantage point today, which very few companies can boast of, because we don't just cover the public markets, and our ability to understand public markets is there, but we have a holistic understanding of private companies in spaces. If we can go to the next slide, Tridib. So this is more on our asset management platform. As we mentioned, it is in excess of $1 billion. Very specialized strategies, long short strategy, the long only strategy, which Tridib heads for the entire group, and private equity, which I just spoke about. The approach is institutional. We want to build a business around processes and build it in an institutional manner. We service both Indian families, Indian HNIs, as well as international customers. Some of the largest strategics and corporates and venture capital funds are our clients today. And today, in asset management, we have more than 50 professionals. I think everything is around process, it's around people, it's around risk management. Those are the three things we focus on. And my colleague Tridib will talk more about those things. If you can go to the next slide. I think this is where we stand out differently, and this will give you a context of today's discussion as well. We have today the largest franchise in India and potentially the largest in Asia in terms of digital and technology investment banking. I think we are today doing deals at a velocity and momentum which is very, very strong. Essentially, what we are doing is we are helping these digital and tech companies, and we have been doing that for the past 10 years plus, helping them raise capital, helping them do strategic transactions, mergers and acquisitions. More importantly, aligning ourselves and understanding the businesses with the entrepreneurs, and then seeing what is the best way for them to grow, what kind of investors would make sense for them. And just to give you a sense of what the velocity is, we've closed 50 deals in 18 months. And just let that number sink in, because a lot of investment banks over their lifetime of 20 to 30 years have not closed those many transactions. So what that gives us, this is not a boasting thing. This is more to tell you that we have a perspective which goes very deep into some of these businesses, industries, companies, and hence we carry that requisite knowledge and know-how of these companies going back more than 10 years for companies which are older, for companies which are newer. It's kind of as long as they are there. So these are companies in the digital and tech universe, as you know, which have kind of come up in the last 10 years and have grown substantially. We have 60% market share in this area among all investment banks and advisors. And then we have, you can look at the list of companies, which I would say is probably a representation of the kind of clients we have worked with very intensively, whether it is Nykaa or BookMyShow or Byju's or Licious or Dream11 or Lenskart, Unacademy. I'm sure you've heard of a lot of these names, both as consumers as well as watching how these companies have grown and taken investment from some of the highest quality investors. Avendus has been alongside these companies, helping them raise the capital. And besides that, what we've done is that a lot of these companies have offered us an ability to sell stock, which we've done to HNIs and to other participants in the ecosystem. We have one of the largest teams in the country, again, probably in Asia, focused on digital and tech. So that gives you an overall perspective of what we are going to talk about today, which is essentially what changes will we see as these companies go from the private world, they take a step into the public world. Zomato is just one such example, the first of the examples which we've seen in recent times. But is it the beginning of things, or have we reached a saturation point? Are investors getting it at a time when these companies have already matured and grown? or there is still a lot of runway ahead? Those are the kind of questions we want to address today. And I'll pass it on to my valued colleague, Tridib, who can talk about in more depth and detail. And of course, we'll be taking some more questions in due course, as Mr. Sivaram suggested.
Thank you, Mr. Ranu, and you have set the context beautifully. And the strategy will be presented now by Mr. Tridib. Over to you, Mr. Tridib.
Thank you very much, Ranu, for setting the context. The digital e-commerce world now is moving from the private space to the public markets, and I think the public equity markets are definitely going to see a sea change as we go forward. We'll try and cover some of those aspects. Along with that, of course, it will open up new paradigms, new ways of looking things. We'll try and cover some of those issues which we would like to highlight. But at the root is the mainstreaming of digitalization. In the post-COVID world, what we see, there has been a rampant acceleration of so many mega long-term trends, one of which is digitalization. And in the case of India, India was already a digital-ready country, in that sense. Three things out here. You see very fast digital adoption by consumers. So there is a consumption economy which is booming, led by the digital channels. And now it's becoming mainstream. Everyone is playing a role in that. The mainstreaming also includes the fact that traditional businesses, be it large, small, or medium, they are being forced to adopt digitalization in the way they run their business. And we will try and show you some aspects on that as well. And of course, as Ranu mentioned, public listings of many of these startup digital tech companies will finally allow public participation in this economy, which is going to be quite huge as we go forward. And we think it has just yet started for India. We are at a particular threshold, which we believe is a digital breakout level for India. Similar to what happened to China, and the per capita GDP threshold of $2,000 to $2,500 is very pertinent out here. China crossed that barrier somewhere around 2006, 2007. And not only GDP, per capita GDP growth accelerated, but with that, a lot of discretionary consumption got a boost. And with that discretionary consumption, obviously the whole digital breakout happened in China over the last 10 to 15 years. Discretionary consumption with higher income levels obviously leads to more and more internet users becoming online shoppers and online transactors. We believe India is definitely at that stage. We are at the threshold of $2,000, $2,100 per capita GDP. And as per IMF projections, this definitely will accelerate as we go forward. So we are exactly in line, or rather a few years, 6 to 8 years behind China. These two charts actually show the picture as to how India is actually following the China story in terms of economic development and digitalization of the economy. Today, we have nearly about 78 crore internet users in India. China already has 1 billion. About 57% of our population today has internet access, especially on the mobile phone, which was the case with China just about 2018. This will have to accelerate. Mind you, today's 78 crore internet users have actually gone up 3 times in the last 3 to 4 years. So there has been a rapid, and thanks to low data prices, the lowest in the world, there has been an acceleration in the internet user community in India. And logically speaking, as we go forward, those internet users will convert into shoppers. Just about 150 million or 15 crore online shoppers in India today, roughly on rough estimates, which will certainly grow to around 35 crores in the next 4 to 5 years. So you'll have a nearly 3 times, or nearly 2.5 times explosion in the number of online shoppers in India, exactly the same way as it has happened in the case of China. China already has 75 crore online shoppers and transactions as we speak today, and nearly half of the population transacts online, or deals in online commerce. So I think this sets, there is now a very strong ecosystem already created with the success of Amazons and the Flipkarts and Paytms and Olas and Ubers. So there is an infrastructure ecosystem already created, on the back of which the digital breakout, we think, is on its way to happen. The entire consumer digital economy of India, it is estimated will go up at least 10 times in 10 years' time, indirectly meaning about 25% odd compounded growth rate from a base of 85 to 90. This is the entire consumer digital economy. So this includes not just e-tailing, but also other services and everything. And as I mentioned earlier, online shopper base is set to grow from 15 crore to around 35 crore in the next 3 to 4 years. Several factors will help this faster adoption, apart from the per capita GDP part, which I mentioned earlier. It is increasing focus on tier 2 plus cities, tier 2, tier 3, tier 4 cities. Just to give you an example, Nykaa is coming up with an IPO very soon. And already 60% of Nykaa's sales comes from tier 2 and tier 3 cities. Mind you, it's a beauty and personal care product company and going into fashion category. But already more than 50% of its business comes from tier 2 and tier 3 cities. So more and more of these companies will focus and expand their presence beyond the metro and tier 1. And that is only going to expand the digital economy as we go forward. 2/3 of India's population is digital natives, what we call as millennials and Generation X, Generation Z, all people in the range of 15 to 39 years of age. And this cohort is definitely going to be the one which is going to adopt online spending far more easily. And as they grow and as they get more higher income levels and higher discretionary income, it will show up as we go forward. Interestingly, many of the companies are now, adopting a lot of innovations to help foster this growth. And more particularly in the case of India, the vernacular user interfaces. It's not just English that you need to know if you need to really transact, and also things like voice and visual search. So all this will further help and accelerate adoption and online shopping as we go forward in the next few years. And this is what we mean by the digital breakout part. And obviously, COVID-19 has finally brought the change in consumer behavior which was needed, which earlier used to be looking for discounting. Online used to be a platform for discounts. I think that is changing. The preference is changing more towards convenience than just mere discounting per se. So I think all these factors, as we see, is going to give a rapid growth in the consumer digital economy in India, which obviously is leading to India's startup economy coming of age. Already we have nearly around 53 unicorns. This number keeps changing almost every month, so it's difficult. Maybe it could be 54 or 55 today. But around 53 unicorns. Interestingly, and unicorns is basically companies with a business value of more than $1 billion of business value as per last valuation. But in the last 18 months, half of these have become unicorn only in the last 18 months. So nearly about 26 or 27 of them became unicorns in just the last 18 months. And you have another cohort of 25, 30 soonicorns, which are soon going to be unicorns as we go forward. So mind you, in the world, there are just about 800 unicorns in the private space, and India already has 53 of them, which is not a small number, I would think. And this obviously is going to lead to a very, very long list of IPOs in the next few years, in the next 3 to 5 years, more particularly the next 2 years as well. And if we look at the current listed, the new age companies, companies like Zomato and Make My Trip and India Mart and all. If I add up all those companies, we have a current market cap of around $38 billion. And we think potentially from whatever has been spoken of from the media and from company interactions, there is a potential $250 to $300 billion of market cap going to be added by way of IPOs as we go forward, more possibly in the next 2 to 3 years. And mind you, this $250 to $300 billion is at current business value. So it may ultimately come up at a different valuation as you go forward, in the next 3 years. But $300 billion would, mean around 10% of current India's market cap already. So as we go forward in the next few years, this set of companies are definitely going to account for a much larger portion, maybe around 15-20% of overall market cap in India, and it is only going to grow. This will play out the same way as it has played out in the US and Chinese markets, more particularly Chinese markets. And if I were to show you the chart here, which just shows how only the top 20 companies, and we took deliberately the top 20 companies in these indices, how many of these are digital tech companies in the top 20 companies, and what is their weightage as a percentage of the total index. So obviously US has most of these innovation platforms, nearly in the S&P 500, it's already about 23%. But look at China, already 38% of the top 20 companies, or rather 38% of the index is accounted for from the top 20 companies, is accounted by digital and tech companies. Particularly, since Zomato has recently IPO'd, it'd be interesting to note Meituan, which is also a food delivery company in China. It processes orders in 3 days, what Zomato and Swiggy put together do in 1 full month in terms of orders. So this is the scale of the kind of growth in the digital economy possible. Not necessarily they'll follow the Meituan way, but the fact is this is just an example which is we are trying to give you to show how we think we are at a breakout level in terms of the digital economy going forward. And that breakout level is now finally coming to the IPO markets in India. And that is very pertinent to note. There's a permanent change out here as we go forward. But at the same time, we would like to de-glamorize these businesses in a way. There is a lot of glamour attached to them. And if you look at it closely, especially from the India point of view, it's important to note that at the root, most of these businesses are convenience platforms, transaction platforms. They bring a convenience, and they're either selling you a goods or a service. Unlike innovation platforms. So you have a number of horizontal marketplaces like JioMart, Amazon, Flipkart. You have verticals. You have India Mart for that matter in the horizontals. In the case of verticals, you have Big Basket on groceries, Nykaa on beauty and personal care, and Myntra on fashion, and so on and so forth. So, and in the services space, you have obviously the Zomatos and the Swiggies in the delivery space, and in tourism, you have Oyo, and transportation and logistics, you have Ola, Uber, and and delivery and all. But what we're trying to stress out here is that if you look at it in a de-glamorized manner, it's important to understand the businesses, the underlying businesses per se. They're essentially the business of selling goods and services using the digital channel per se. And of course, digital channel adaptation is leading to very high growth in them. So many of these businesses will be successful going forward with the success of the digital channel. A lot of doubts, a lot of questions on some of these, digital companies which are loss-making. A lot of doubts about are we investing in profit-less prosperity and all that, and loss-making companies coming for IPOs and all. I think it's a very pertinent point, and we thought we'll bring in a conceptual framework out here. Comparing, and this is just a framework, okay? This is a very, very rough framework, which compares a traditional business with a digital stroke e-commerce business. And most of the public participants, public equity market participants are used to, looking at traditional businesses there is always a project implementation period, even for an existing company. If it expands its manufacturing capacity, there is a project implementation period when the capex takes place. And of course, after the capex is commissioned, the project is commissioned, you have sales coming in, and of course, with that, profits coming in. And that is the traditional idea. Even if it is true for a service, let's say a hotel or a restaurant or something like that, there is always an implementation period. That's what we get used to. The implementation period, project comes commissioned, then sales start, and then profits come. But in the case of most of these digital e-commerce companies, when they start, their sales start coming in. There is no particularly long gestation project implementation period, so their sales start from the day one. But obviously, they are building the business and they are getting customers, making customers change their habits, and building a customer base. So they are bound to make losses in the initial period, just because they started making sales from the day one. So I think that is the difference between a digital commerce business and traditional businesses. Maybe there is a case in some of these companies to look at the cash losses more as a kind of capital expenditure to build the business, to get the customer acquisition cost, customer behavior change cost and establishment and all that. And obviously, once you reach a critical mass, your path to profitability comes through. Of course, there is no scale involved in these two charts, so it is just more of a figurative charts. But we think this appreciation is important because if a digital or e-commerce company is not making profit or making losses, it does not mean there is no investable case per se. Investable case, of course, remains on valuations, and this is where we talk about our framework. We think it is not very difficult to value these companies. It's a lot of basic, understanding out here, wherein the first acceptance should be the fact that there is only one way to value a business, any business in the world, which is the discounted cash flow analysis. Every asset has cash flows in the future, and the value of any asset is the present value of those expected future cash flows. Okay. And this is true for existing traditional businesses, listed on the exchange as well. It is just that because of ease of use and because of practicality of usage, we use the relative valuation measures like price to earnings ratio, EV to EBITDA, price to sales. But each of these are nothing else but an approximation of the discounted cash flow analysis. We can actually derive at a P ratio from a DCF analysis, per se. So because of ease of understanding and ease of use, people have got used to P ratios and price to sales ratios and all that. But in the case of the digital and e-commerce space, we believe even if you use anything like a price to sales, because there is a sales out there, near-term valuations and relative valuations will always be misleading, because these are high growth businesses, and near term, next 1 year price to sales or next 1 year EV to EBITDA, if there is an EBITDA, will always be very optically high, and will not give you the necessary conclusions, okay? Because the share price is actually building in long periods of high growth, okay, and eventually a profitability, over a period. That is why at Avendus, we prefer to look at these companies from a reverse DCF analysis, and without complicating it further. What we mean by that is we try to assess at a valuation of a company, let's say today's share price of any such company or any company in the traditional businesses also. At this current share price, what is the current share price telling you about what is the embedded assumption on certain key important parameters of the company's business? For example, the share price of any company today tells you something, and if it is accepted as the true value of the business, the current share price, it tells you something about the future, let's say, sales growth of the business for the next 5 and 10 years. Okay, and if we find that this embedded expectation in the current share price, if this embedded expectation is conservative, let's say a company's share price tells you that the sales growth is going to be 5% over the next 5 to 10 years, and if we find that no, the sales growth can actually be much higher, then it shows that it's an undervalued company, in that sense, and gives you a very good sense of where you are standing, in terms of, and it takes into account future cash flows, the future growth prospects of the company. So we think instead of really spending much time in looking at near-term valuations and relative valuation measures in the case of some of these companies which may have a lack of profit right now at this stage of their evolution, it's important to look at it from a reverse DCF analysis to get a gauge as to whether the current share price is building in what expectations of growth, and those growth expectations realistic. If those growth expectations are conservative, that means the share price is attractive and it's worth a buy. And if those expectations embedded in the current share price are extremely positive or highly optimistic, then it would mean that it's not worthy to invest. So we think from our framework of understanding these digital businesses, very much the same aspects are taken into account, in terms of size of the opportunity, the competitive advantage, execution ability, and so on and so forth. And lack of near-term profitability may not be a concern for us. We look at reverse DCF and try to assess these businesses. And that is what we think public markets also will do as we go forward. So that is one part of the equation. The second part, which is also a larger story, we think, which is traditional businesses are also transforming digitally, and with data and with the availability of data, with data processing, data analysis, and data monetization, you have a whole feedback loop in an existing traditional business, which is being used to further improve your supply chain economics, because it touches you from the raw material stage to the consumer stage, and consumer data can be processed. So the whole digital feedback loop is what traditional businesses will need to adopt to and transform digitally to take advantage of, so that they can improve and economize their supply chains further. They will reduce production costs, even automate their production, as well as digitize their entire distribution infrastructure, in terms of reaching out the go-to-market strategy to the consumer, and so on and so forth. So I think digital transformation up till now, before COVID, used to be a nice-to-have kind of a thing. But now it's going to be a must-have for traditional businesses. And those businesses which are ahead of the game on transforming themselves digitally are the ones who probably will gain more market share, or they will be businesses which will actually grow faster, we think. So digitalization, the mainstreaming of digitalization for us is not just IPOs of digital companies. It is actually equally importantly, how are traditional businesses really coping up, and what are they doing digitally which will enhancing their ability to grow faster or compete better. So I think that's a very critical piece in the whole equation. And because as we go forward, mainstreaming will ultimately lead to convergence, which is already being seen. Traditional businesses are actually adding online to their offline part. So of so many FMCG companies already having 5 to 10% of their business coming from online, channels already from e-commerce. We know of a couple of FMCG companies like Imami recently, or even Marico earlier, who actually have launched digital-only brands. They've launched brands only on the digital platform, and seen consumer feedback and consumer, the success of the product, and then brought it offline, in their distribution channel as well. Similarly, it is not surprising to see that many of these digital and e-commerce businesses are actually moving, also adding offline from the online part of the business. So you have Nykaa, which I think has about 76 stores already, physical stores. So many of these businesses which are online are actually slowly adding physical presence. We also, recently saw a Policy Bazaar talk of, opening broking branches because they're getting into insurance broking per se. We've seen Farm Easy take over Thyrocare for that matter, and all that. So some of these are, very strong inclinations towards the fact that as these digital businesses grow, they will also need to have a physical presence. And the physical businesses will also have to have more digital presence. So I think maybe 10 years down the line, all of us will stop talking about digitalization because it would have become mainstream, in that sense. But yeah, the next 10 years is going to be quite exciting from that point of view, from a public market point of view. I'll pass it over to Ranu to, give a feedback on what are the factors which needs to be watched from a public market perspective.
Yes, I think the important part, I think, which from an investor's perspective would be valid is, and the questions which are coming is that when these companies are valued at the numbers that they are, the multiples that they are, what are the important things which longer term investors should look at? I think one of the more important things which one has to look at is growth. I think these companies are being valued on growth, and growth is a function of several things, right? Growth is a function also of how high is the ceiling? What kind of an addressable market are you operating in? Right? If Zomato is delivering X number of meals in a month and a Chinese company is delivering the same number of meals in one day, that means there is a possibility, opportunity, or headspace available for Zomato to kind of grow. Similarly, in most companies, as Tridib talked about, there is a possibility of a breakout in terms of market growth, and with GDP growth, discretionary consumption will come an increase in the addressable market. But more importantly, we are operating at a level which is very low as compared to the size of the total market. So if these companies continue to do well, I think we lost the slide, but if these companies continue to do well, what is important is that the addressable market will, the companies will grow up and expand to take as much of the addressable market. The second part is going to be execution excellence. A lot of these entrepreneurs are young entrepreneurs. They are in their 30s. They are not people coming with backgrounds in Unilever, P&G, ITC, who have spent decades building distribution businesses. So they are learning the tricks of the trade. They are very agile. As I like to say, they are turbocharged entrepreneurs and very different kind of mindset. So they bring in innovation even in execution. So how do you address a market which has not been established yet, or where you need to do something in 3 years where some company has done in 20 years? You do that by bringing in speed, you bring in innovation, and solutions work out, and also you have a lot of resources to kind of support you. So all of that leads to a question around excellence in execution, which is a very important part for all of these companies, and what will determine whether these companies are able to take that addressable market, and whether the investors will reward them or punish them will be based on how they go and stack up to their milestones on execution. There are other things pertaining to unit economics and path to profitability. Unit economics, as you all know, is something which is important to watch out for. I think if a company is on an overall basis producing a loss, but its unit economics is different and increasing and becoming better, that portrays a very different profile of the company as compared to a company where the unit economics is under pressure. So there is going to be a focus on unit economics. And then the last part is path to profitability. And path to profitability is something which comes in, every time people are bullish, the path to profitability gets deferred. Every time the markets return back to practical levels, path to profitability gets questioned. But these are long-term models. That does not mean that the market does not expect them to be profitable. So just to illustrate, when Uber came out with its IPO, the red herring prospectus said that we may never be profitable, right? Now, those kind of things are very radical. I think the investors still expect that these companies would get to that level of profitability. And our current data shows that as much as 30 to 35% of the unicorns are profitable, at the EBITDA level, which is a reasonable kind of a measure. So, which means that there's no concept that all these companies are loss making. These companies are pushing forward on unit economics and making a kind of bringing the path to profitability closer. I think the other parts which I think are kind of important is there will be a very important phase where there will be a kind of a duopoly in some of these businesses. We are used to businesses where there are 10 participants, 15 participants, participant number 14 goes to the public market, participant number 12 goes to the public market, and the market is as receptive sometimes. This is a very, very different industry. Digital is an industry where the top 2 or 3 players walk away with most of the revenue, market share, and profit pool share. And disproportionate value accrues to those 2 or 3 companies. So it is very important for investors, if you want to kind of see this transition in capital markets and you want to take advantage of this transition in capital markets and generate the kind of alpha you expect to generate or you aim to generate, it is important that you identify who among the 10 companies would be which of the 2 companies or 3 companies would be the clear leaders and take away disproportionate market share, because those companies will give you returns very differently from others. And it is not kind of a surprise for most of you, because you've seen companies like Amazon and Facebook and Apple take away disproportionate market share and value, whichever areas they're operating in. So I think the overall message is the capital markets are now going to see what the private market saw over the last 10 years. Great companies coming to market. I think the important part to me is going to be making right choices of the companies you want to invest in, as opposed to being very fussed about valuations. Valuations are relative. Valuations, as Tridib also mentioned, you can be scientific to a certain extent, but you have to be driven by what the peer group in China or the US tends to get. And accordingly, do not just base your decision on a metric called valuation. I think it's important to choose the right companies with the right founders, because those are the people who can make a difference in creating a 10x outcome for you, as opposed to making a 2x outcome for you. I'll pass it on to Tridib back.
Sure. So I'll just use this opportunity next 2-3 minutes to just introduce our product, Avendus Olivo. It's a PMS product. It's a core equity portfolio. So of course, it's only investing into listed equities, long only listed Indian equities. And this is our flagship long only product. We launched this product 7-8 months back on a full operational basis. And of course, only in the listed space. Very high conviction focused portfolio of 15 to 18 businesses. We invest only in 15 to 18 businesses. But we have a special focus on businesses which are benefiting from next generation megatrends, including, as we discussed, the mainstreaming of digitalization. I'll talk a little bit about that as we go forward. It's a well diversified. We are actually market cap agnostic, sector agnostic. We want to have a diversified portfolio within a high conviction focused portfolio strategy. It's an all cap strategy. We don't believe in market caps. We look at businesses rather than the size of the business. And of course, we're happy, in terms of if the business is having enough ability to give us long-term value creation, we are fine with it. We are completely fundamental equities oriented. We have a very strong investment process and research orientation. And of course, we think that Avendus Olivo is actually an all seasons core strategy, which tries to be right at the center of an investor's portfolio. That is one. As Ranu mentioned earlier, we have a very strong investment process. Our whole objective is to have institutionalization of investment management. We don't believe in star fund managers, or we believe in teamwork. We believe in a very disciplined investment process, which we think allows us to have repeatability of our performance and scalability of our ability to do work. Just as an example of the special focus I was talking about, while it's a long only listed equity PMS product, we're definitely having an eye on some of these mega trends, and especially so the mainstreaming of digitalization. And as opportunities come through in the future, we will exploit that as we go forward. And as I mentioned earlier, that there are many traditional businesses which are benefiting from digital and from the digital world. We have the example of one QSR company in our portfolio whose online or other convenience channel sales have gone up from just about less than 40% of their business to nearly 70-75% of their business today. So that's what is driving growth per se. So it is ability to transform digitally and use digitalization as an advantage for a traditional business. So of course, we have examples of one advertisement technology company as well, and so on and so forth. So our special focus, while it's a general listed equity, PMS, it's a core portfolio, we will definitely have a special focus on some of these mega trends, especially mainstreaming of digitalization. And of course, global supply chain, China plus one strategies and all that. We have successfully invested in an electronic manufacturing service company in the past, and of course a small cap pharma company which is into contract manufacturing. But these are just examples. I thought we can just bring it forward to you. I would not take much time now because we've already overshot the time, I guess. So we will stop here for questions. I'm happy to take both Ranu and myself will be happy to take questions.
Actually, both of you have answered most of the questions people had and the investors had in mind. And you have some pointed questions have come. Mr. Ranu, this question has come to you. And China tech crackdown has resulted in steep fall in technology stocks in China. Is there any distinct advantage India will get in terms of flows because of the problems and the crackdown in China?
I think the crackdown on tech stocks in China is part addressing a very large issue there, which has happened over the last 10 years. I think when the stocks are falling from a certain level, you have to see what kind of level they have reached in 10 years. I think it is important to see that in context. For an investor who's been an investor in tech for only 6 months in China, they've seen only bloodshed. But for investors who have been there in the tech market in China for the last 10 to 15 years have seen only glory, right? I mean, I think if the movement has been from 1 to 100 and that 100 has come to 80, depending on the period you invested, you will find different outcomes and different level of happiness of investors. I think what is important to see is that if you look at China, what has happened there are certain sectors they've gone after. They think they have created enough billionaires over the last decade. Enough value has been created. They want to address a few things like in areas like education, areas like housing, areas like healthcare. And now today I hear even pharma and liquor and some of the other areas they are going after. But see, India is in a very, very different stage of evolution. We just pointed out that India is still several years behind China, maybe at the minimum 6 to 7 years behind China. We do not have the kind of complications which have arisen in China. So I'm not trying to dismiss their move as something which is a wrong move, or I'm just saying we are at a very different stage. We have to create that wealth. We have to take this opportunity to get as much investment into India and be investor friendly in terms of a regulatory environment. And if that is the case, I think India will benefit. We were just having conversations with an Asian investor who was only looking to allocate to China. Now, they're still allocating to China, but they're now keeping 25% aside for India. So that is the change which is happening. China is too large a market for people not to be engaged there. But what people have started doing smartly is people have started diversifying into markets like India. And if I look at just that diversification pool, it is significantly large for India. So I think that's a very big opportunity for us. I do not anticipate any immediate short-term knee-jerk reactions from the Indian government along the lines of what has happened in China. So we still have a long runway ahead of us.
That is very encouraging. India is going to get a lot of flows, and that is a great news for investors. So, Mr. Tridib, this question is for you. The valuation of the market is very high as of now. How do you see the market shaping up in the next 3 to 5 years?
Sure. So I have a couple of slides on that. So I think what has surprised most investors is a lack of any correction in the second wave, as you can see from the chart here. And I think, as expected, the second wave was short-lived, about two to 3 months. So I think there is increasing realization of the fact that you have to look forward. And what is forward is the fact that earnings growth momentum is going to be extremely strong. India is and will be for the next 2 years at least, maybe for the next 5 years, one of the fastest, the fastest large economy in the world. Okay. And I think a lot of the problems which we saw in the last 5 years, which was a profitless recovery or a earnings growth recession, was because of a lot of these reforms which were disruptive in nature. You had demonetization, GST, then RERA, and then insolvency and bankruptcy code and all. These kept on, in a way, interrupting the growth. Okay, so I think that is now we probably behind it now. So we expect very strong earnings growth. In fact, you can see here, despite the second wave, earnings growth confidence has remained intact. In the markets, there's hardly a dent. Okay, which we agree to. As we look forward, we think what the market is building in, while the valuations may be higher than what they were, earlier. But if I were to look at the next 3 to 5 years of earnings growth trajectory, we find a lot of strength out there. So the earnings growth, first GDP growth, and with that earnings growth are crucial. What these higher valuations are reflecting in the meanwhile is also the fact that you are finally seeing improvement in profitability and deleveraging of corporate India. So if you see the debt to equity ratios have gone down, we expect the return on equity, as per Bloomberg estimates, consensus estimates, return on equity of BSE 500 will finally touch back to around 14-15% in the next 2-3 years, after having fallen from 17-18% to nearly around 10%. We'd had a lot of earnings growth recession in the last 5 to 6 years. Corporate profit to GDP for India used to be in the region of, if I take BSE 500 as a base, in the region of around 3 to 3.5% of GDP. That has fallen to 2%. So we had economic growth, or maybe also muted economic growth, because of a lot of these disruptive reforms. Okay, the impact of which has waned now. And the budget was extremely important from laying the foundation for a capex-led, and more from a productivity improvement-led, stimulus per se, which is going to result into a very strong earnings growth trajectory over the next 2 to 3 years for sure, resulting into improving ROEs, lower debt to equity ratios, because corporates have deleveraged and all that. So I think the valuations are reflecting all that, and we are quite confident. While there always will be corrections, we don't know what's going to happen in the next 3 months and 6 months, and we don't think anybody knows, because markets are like that. In the short term, they will always be volatile. There will always be corrections here and there, but if I were to look at a compounded trajectory over the next 3 to 5 years, earnings growth momentum is definitely there for sure. And that will lead the market, I think.
And investors need not fear the ghost when none exists, is what Mr. Tridib is saying. The next question is also for you, sir. Mr. Tridib, Can you explain your investment process of your fund, and what is the team size of your research team? Someone wants to know.
Sure. So, no, good question. So we are an 8-member investment team with an average experience of around 17, 18 years, I would think. 2 of us, myself and my colleague Gaurav, the 2 portfolio managers, we have nearly around 30 years of experience in the market. 4 of our analysts have, on an average, around 15 years of experience, and all. So we have a very mature, large 8-member investment team. To answer your second question first, insofar as the investment process is concerned, I'll just bring about a couple of slides from our corporate presentation on Avendus Olivo. For us, investing is a combination of art and science. We think investment management, investing itself is also art, but it has to be based on a very strong foundation of a very scientific way of working. So the art part represents your qualitative judgment. It represents the qualitative aspect of thinking, the judgment part, even gut feeling for that matter. But it cannot be sitting in isolation. It has to be on the basis of a very strong scientific way of working. So what we have at the heart is our coverage universe. We have 145 companies in our coverage universe, where our entire 8-member team only focuses on these 145 businesses in India. we have scanned through nearly 1,000 odd companies and used a lot of guiding criterion, to eliminate them, not allowing them to come into our universe. Some of these criterion are in front of you. And we've got a list of 145 businesses. Of course, this is not a static coverage list. We keep adding to our coverage, and we keep redeciding on certain companies in the coverage. There is a very strong ideation engine. So for us, it is not just investing, but ideation itself is a matter of a process. So we work very consistently on new ideas, through things like management change or underperforming businesses or mega trends, which I've already explained to you in detail. So that gives us the coverage universe of 145 odd businesses. We have a detailed financial model on each and every of these coverage companies. These may not be necessarily in the portfolio, but even if a company is not in the portfolio, it necessarily has to be having a financial model from our side, which goes back 10 years and 3 years, 3 to 4 years in the future. And of course, we value each business in the universe, whether it is there in the portfolio or not. Because we have a financial model, we can value each business. And I explained reverse DCF in a little bit detail to you earlier. But we use various relative valuation measures, and we arrive at the value of each company in the universe, which then enables us from the next 3 years perspective, 2 to 3 year perspective, how do each of these 145 businesses stand relative to each other in terms of expected return, from a 3 year perspective. And that gives us a laundry list of around 40-45 companies out of this 145 companies, which we can choose from and create our portfolio. So it's a very step-by-step process. A lot of teamwork is involved here, and it is quite disciplined. This 40-45 businesses we ultimately isolate. From there, the science part stops there, and the art takes over, which is the judgment, the qualitative assessment, and then allowing them into a portfolio to create a diversified but a very high conviction focused portfolio per se. So that is what, in short, our investment process is all about. As I said, 8-member team, each of them well qualified, well experienced. And of course, we are in the process of investing in our business more and adding to our team as we go forward. We will add more resources to our team, and we are only going to expand our investment team. So I think this was a quick answer on your investment process part.
You had an enviable record in your earlier stint. People perhaps wanted to know who is behind the fund other than you. We will go to the next question, sir. Okay. Management is the very important factor for selecting a stock in a portfolio for a fund manager. How do you assess a management ability and an integrity of a new age company before investing, as they have no previous record at all?
If I can, I can take that question, Mr. Sivaram. I think, and I saw another question on corporate governance also. I just want to tell you that the typical founders who are coming in this category of companies are not people who have run businesses in India over the last 30 years, 40 years, seen the license Raj and come out of it and done things in a certain manner. Very often, these are also people not coming with any business family background. They're all professionals. They're techies very often, and they're coming in with very aspirational kind of ideas on what they want to do. Also, their shareholding in the business is low. Their shareholding in the business can go at the time of going public to as low as 5-6%. As compared to other companies where the founders, promoters have in excess of 50% holding, where the founder stake can actually go lower. And these companies are usually invested in by good private equity funds. So they have lived their life virtually with institutional capital from day one, and not kind of, most of these companies would have that institutional capital. Now, it is a question mark that with institutional capital, with its diligences, if there is a company which is fraudulent, I mean, there is still a possibility. One can never rule that out. One can never rule out possibilities. But by and large, we've seen the corporate governance in this area is a lot better. I would say several notches above corporate governance in the rest of corporate India. And just in terms of figuring out whether a company integrity is good or not, I think you have to, I think what we do at least is we try and triangulate information coming in from a company. The easiest way to figure out, whether the data coming out of a company is correct, incorrect, it's in the gray, is to just do, today there is enough data available from different sources. You have to just triangulate that data and see whether it is stacking up or not.
It is from my side to you, sir. And in the future, from promoter-backed companies, are we going the board being the decider for all the decisions? Are we going towards that? What do you think, Mr.
I think in our minds, it's not that the boards are running these businesses. So let's be very clear. I mean, there is a board, there is an active board in each of these companies, but they're not board-run companies. Most of these companies are run by founders, and this applies even to companies globally. Some of the best companies globally, and large companies at that, have significant ability of founders to take decisions. This is a business where agility counts. You have to take decisions because those decisions are so material that they can make a difference between you succeeding or you failing. So there has to be a founder who's taking those decisions very often. The board can, provide enough support to the founder or the founders, but by and large, these companies continue to have, a significant amount of founder involvement and ability to influence the destiny of a company.
Mr. Tridib, this question is to you. And the risk management is very important in the new age companies. What is your risk management process you have in place to avoid accidents in the portfolio?
No, excellent question. I should have addressed this at the time when I was talking about the investment process. But thanks for asking this. So for us, I think risk management is extremely crucial. And the one important point which we want to highlight is that at Avendus, we have a centralized risk management function, which is outside of the purview of the investment team at Ocean Dial, which is the 100% subsidiary of Avendus. So at our long-only team, we don't have risk management in our team or in our company residing. Risk management function is at central Avendus capital level. And so they are completely independent. There is an oversight on a daily basis on some of these risk limits which have been agreed upon with the risk team. So I think the independence of a risk management function not sitting with the investing team is extremely important, and that is what we have achieved, and that is a big differentiator according to us. So some of these limits which have been agreed upon. Most importantly, we have a stop loss review trigger, which is very unique. So we have an official review trigger if a stock falls more than 25% in the portfolio, irrespective of the market. Okay, we are supposed to justify why we are not selling out from the stock. It may be that there is a business case we want to hold on, but we are forced to review it, okay, by the independent risk management function and all that. So we have a very good stop loss review, a trigger which makes us review it. And apart from daily monitoring of these risk limits, we don't invest more than 10% at cost in a stock, and not more than 13% at market. There are sector caps, individual sector caps, irrespective of the benchmark. Because we think those are important. But I think I would continue to highlight the independent, centrally based risk management function as the most important aspect of our risk management.
And in your presentation, Mr. Tridib, you told 30%, 38% of the market cap of China is with the technology companies, and we are in the nascent stage. How do you see and where we will be placed? It is only a guess. No one can be accurate. Still, what is your input down the line, 10 years down the line, if we see? What will be the contribution of technology to the overall market cap of India?
Yeah. So mind you, this 38% is only digital company in the top 20 companies of MSCI China.
All right.
Okay. So it is higher actually,
Okay.
So that is what we wanted to highlight, that even if you take only the top 20 companies, you have a very large weightage per se, obviously because they have become large. And a similar kind of trajectory We can't take percentages out here, but yes, we disclosed to you that we think based on the long list of IPOs itself, you can expect at least $250 to $300 billion worth of current business value, which can come into IPO market. Which would mean at current business price, that is the market cap which can be added, which is roughly 10% of India's market cap, itself in the next 2 years. And obviously, as time progresses, and many of these businesses become more successful and become larger, and more unicorns get IPO'd, and more unicorns become unicorns, and unicorns get listed, and all that, it was only going to grow. So 10% is definitely looking possible, at least 10% in the next couple of years or so, 2 to 3 years, I would think. But as we progress, since you asked about 10 years, it would be safe to assume that we would somewhere be going towards the China trajectory, considering the fact that we are at a digital breakout level, at a critical juncture of a per capita GDP, which will definitely lead to a kind of a very strong spurt in consumption, and consumption will be aided by the digital channels in a big way.
With the combined wisdom of more than 5 decades between you, Mr. Ranu, and what is your closing remarks you want to give for the participants today, sir?
Tridib, would you like to go first?
Yeah, sure. So I have been a public market participant all my life, and what this subject was important to highlight from the public market participation point of view, that yes, there is going to be a lot of change as we go forward, and it brings in new paradigms. It brings in necessity to understand these businesses. At the root, these are normal businesses like any other business, so the same criterion apply as you assess a business otherwise as well. But of course, some of the nuances will change, in terms of lack of profitability. So valuations, the way you value these companies, it doesn't change, but the fact is you have to look at valuation from a different angle, and not necessarily, as Ranu mentioned, from a relative valuation, near-term, measure point of view. Of course, being aware of all this, it's important to align yourself with strong businesses at an attractive valuation, which you get. But I think public markets are here for a change in terms of not just IPOs of these companies, but also traditional businesses getting more and more digital in their way. And identifying those businesses also is very important from a public market point of view. I think these are some of the points I would like to highlight. Sorry, over to you, Ranu.
So I think I come from a slightly different vantage point than Tridib. I've seen the private markets over the last 2 decades, and less of the public markets. I think what I'm looking at it very simply. I'm saying there was a point of time when public markets used to represent most of what was there to invest in this country. Then between 2010 and 2020, all these companies came up. Today, there is kind of almost like $350 billion of value lying there, which is not small and insignificant, but a significant value as compared to the rest of the markets. And as the next $1 trillion or $2 trillion of GDP gets added, similar amount of value gets added, we think that there is a very big value creation opportunity for investors who want to be believers in this space. I think the question of whether digital, this is a question we faced for the last 10 years. Whether these companies will survive, not survive, valuation is high, valuation is low. I think the time has come to accept that this is mainstream. This is mainstream, and this represents what consumers are doing in India, where they're spending their money, where they're spending their time in India. And this is not just digital consumption. We are all now also talking of amazing companies. When Infosys came up in early 90s, it was a services company which not too many people believed in. Today, there are enterprise companies coming in areas like SaaS, which are exceptional companies which could probably generate equivalent value in the next 10 years. So I think it's an opportunity for investors who believe that this will be mainstream and will stay is important. I want to also reiterate that for the smaller ticket investors, I think it is important to know that this is not a one-way street. I think to expect that this is going to be a one-way street is I would be doing disservice. This is a business where given the valuations, there is a lot of sensitivity to how execution is done, to events. There can be rapid movements in these companies very often. So the complexion of the way some of these companies go will be similar to sometimes what the traditional mid-caps company do. But over a period of 3 to 5 years, that will get averaged out, and hopefully people will be able to see enough growth and momentum. But there are enough multi-baggers out there for people who believe in this and want to stay long-term in this, investing, particularly with the digital intent. I think from our perspective, this is the theme. This is a key theme for us. But most importantly, we are running this as a portfolio. This is going to capture, as Tridib said, a part of the market which we find exciting, where we are going, particularly with respect to themes, whether it is digitization or China plus one, and trying to get the best quality businesses coming in these. So for us, the most important thing is not looking at the last decimal of return, but more importantly, looking at which are the better companies to back over the next few years.
Oh, thank you very much for both of you, Mr. Ranu and Mr. Tridib, and it was very informative, and it was really enriching, and very good reviews are coming in the chat box also to us, the way you explained the strategy, and Mr. Ranu, and you put the context in place beautifully at the beginning, and every question has been answered in detail, and you had the answers for all the questions. And I would like to thank all the participants also. And as we have overshooted by 12-13 minutes, then 1 hour, which was scheduled to have this call for. And I thank you, all of you. God bless all of you. Thank you very much.